Of course, that time coming around again when the Reserve Bank Governor Lesetja Kganyago will pronounce on our interest rates. Now, of course, no change in interest rates is expected today. That's from a Reuters poll of economists. We are in an interest rate hiking cycle, but the interest rate hikes that we've seen have been very far apart, scattered, quite slow, that movement upwards. What we've seen is a rise of 200 basis points or 2% in parlance over the last 2.5 years. Now, of course, rate hikes are used to control inflation. That is something that all officials worry about in South Africa, the rate at which prices are increasing. What is good news is that the price of those increases has moderated of late. Now, the Reserve Bank has a target 3 to 6%, but yesterday inflation coming in below that at 5.9%. All right, let's go live to Pretoria, to the Reserve Bank, the conclusion of the Monetary Policy Committee. Here's Lesetja Kganyago.
Higher inflation outcomes are forecast in the near term before a sustained return to within the target range during 2017. While domestic economic growth prospects appear more favorable following the positive surprise in the second quarter of this year, the outlook remains constrained against a backdrop of weak domestic fixed investment and low levels of business and consumer confidence. Risks from the global environment persist, although volatility in global financial markets in the wake of the Brexit decision has subsided. Prospects for a resumption of U.S. monetary policy tightening remain a key risk to the pattern of global capital flows and to emerging market exchange rates in general, with continued uncertainty regarding the timing and pace of future moves. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 6% and 5.9% in July and August respectively, down from 6.3% in June. Food price inflation in August accelerated to a recent high of 11.6%, with the category of food and non-alcoholic beverages contributing 1.7 percentage points to the overall inflation outcome. Goods price inflation measured 6.1% in August, down from 6.5% in July, while services in price inflation was changed at 5.7%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was also unchanged at 5.7%. Producer price inflation for final manufactured goods increased in June and July to 6.8% and 7.4% respectively, following a decline to 6.5% in May. This acceleration was mainly due to the impact of the drought on manufactured food price inflation, which measured 12.6% in July. This was its highest level since January 2009. Producer price inflation for agricultural products also remained elevated at around 20%. The latest inflation forecast of the bank has improved over the first 4 quarters of the forecast horizon and remains more or less unchanged for the rest of the period. Inflation is expected to peak at 6.7% in the fourth quarter of this year, compared with 7.1% previously, with an earlier sustained return to within the target range now forecast to occur during the second quarter of 2017. Inflation is expected to average 6.4% in 2016 and 5.8% in 2017, compared with 6.6% and 6% previously. The forecast for 2018 is unchanged at an average of 5.5%. The downward revisions are due in part to a lower starting point, lower administered price inflation assumptions, as well as less depreciated exchange rate assumption. Compared with the previous forecast, core inflation is expected to average 0.1 percentage point less at 5.7% and 5.6% in 2016 and 2017, and is unchanged at 5.3% in 2018. Core inflation is expected to remain within the target range over the forecast period, with a peak of 5.9% in the final quarter of this year. Inflation expectations are expected as reflected in the survey conducted by the Bureau for Economic Research, have remained relatively unchanged, but with some changes between the different groups of respondents. Average inflation expectations declined by 0.2% to 6% for 2017 and remained unchanged at 5.9% for 2018. While expectations of both analysts and business people declined, those of trade union officials remained unchanged for 2017 but increased for 2018. The long-term 5-year ahead inflation expectations are unchanged at 5.9% and remain uncomfortably close to the upper end of the target range. Inflation expectations of analysts, as reflected in the Reuters Econometer survey, have also shown successive declines during the past few months, with the median expectations for inflation to return to within the target range during the second quarter of 2017. Long-term expectations of market participants implicit in the break-even inflation rates, the yield differential between conventional bonds and inflation-linked bonds, declined further since the previous meeting of the MPC, although they remain above the upper end of the inflation target range. The global growth outlook remains subdued amid slowing growth in the advanced economies and a general downward revisions to the forecasts. Although prospects for the US economy remain relatively favorable, outcomes have not been consistently positive, as evidenced by the recent weak consumer expenditure and manufacturing sector data. Nevertheless, labor market conditions have improved and the investment slowdown appears to have bottomed. Although the short-term impact of Brexit on the UK economy have not been as negative as initially feared, growth forecasts have been revised down as concerns remain regarding the longer-term investment outlook. The euro area recovery remains steady but subdued. The Japanese economy remains caught in a deflation and low growth bind following a weak second quarter. The recent firmer trend in commodity prices has improved growth prospects for commodity-producing emerging markets in particular, along with more favorable capital inflows. It is unclear how long these positive developments will continue. Indications are that the negative growth cycles in both Russia and Brazil have turned, and both countries are expected to record positive but weak rates of growth in the near term. The Chinese economy appears to have stabilized following concerns about a slowdown earlier in the year, but concerns regarding the financial sector persist. Given the broadly benign global inflation environment, apart from some emerging markets, monetary policies have generally remained accommodative, with further loosening or loosening bias in a number of advanced economies. A notable exception is the United States, where the bias remains for a resumption of interest rate normalization, but the timing remains uncertain. Following the decision of the Fed to keep rates unchanged yesterday, the market expectation is for the next move to be in December. The data-dependent nature of future decisions means that these prospects are likely to change with new data releases, imparting a degree of volatility to financial markets and to global capital flows. The US policy rate trajectory is still expected to be moderate. The rand exchange rate has been affected by these global events, but has also been impacted by domestic fundamentals and political developments. Since the previous meeting of the MPC, the rand traded in a range of 14 rand 73 and 13 rand 28 against the US dollar, and has appreciated by 6.3% against the US dollar, by 4.3% against the euro, and by 5.2% on a trade-weighted basis. The rand initially appreciated markedly in line with other emerging market currencies as the chances of US Fed tightening receded in August following disappointing labor markets data. At that stage, the rand recorded its strongest level since October 2015. This trend was reversed following increased domestic risk perceptions, which were also reflected in rising domestic government bond yields. More recently, the rand has been positively impacted by the stronger GDP growth outcome and a significant narrowing of the current account deficit following a sizable trade account surplus in the second quarter. Although this may reflect in part a delayed adjustment to the depreciated rand exchange rate, the trade surplus is not expected to be sustained at similar levels in the coming months. The marked appreciation of the rand during the past few days appears to be driven by expectations of unchanged US monetary policy, as well as to speculation regarding possible purchases of rand related to a major mergers and acquisitions transaction. The rand, however, remains vulnerable to future changes in the US monetary policy stance, domestic political developments, as well as to a risk of possible ratings downgrade later in the year. Nevertheless, the upside risk to inflation from the exchange rate appears to have moderated somewhat. The domestic economy remains weak despite the positive growth surprise in the second quarter of 2016, when an annualized growth rate of 3.3% was recorded. This was driven by a rebound in the primary sector and a surge in real exports. Mainly as a result of higher starting point, the bank's forecast for economic growth for 2016 has been revised up from 0% to 0.4%. The forecast for the next 2 years have been increased marginally by 0.1 percentage points to 1.2% and 1.6% respectively. Estimates of potential output growth are unchanged, implying a persistence of below potential growth. The trend in the bank's composite leading indicator of economic activity remains indicative of subdued growth. While the second quarter growth performance was more favorable, data for July suggests that this improvement is unlikely to be sustained in the third quarter. Both mining and manufacturing sectors recorded negative month-to-month growth rates in July, and the Barclays PMI declined sharply in August following 5 consecutive months above the neutral 50-point mark. Stresses are also evident in the construction sector, with a further sharp decline in building plans passed during July. A key constraint to the growth outlook remains the sluggish state of domestic gross fixed capital formation, which contributed negatively to GDP growth during the first 2 quarters of this year. In the second quarter of 2016, domestic fixed investment contracted in both the private and public sector sectors, including government and public corporations. Private sector fixed investment has recorded negative or zero growth for 6 consecutive quarters, reflecting low levels of business confidence. The RMB BER Business Confidence Index remains below the neutral level, despite an improvement in the third quarter. This adverse investment climate and rising costs have contributed to the further deterioration in employment prospects in the mining and manufacturing sectors in particular. The official unemployment rate increased to 26.6% in the second quarter from 25% a year earlier. The increase in employment that was recorded in the second quarter was almost entirely attributable to temporary employment opportunities related to municipal elections. Consumption expenditure by households remains weak, despite a return to positive growth following the first quarter of contraction. The annual growth of 1% suggests that consumers remain under pressure. Durable goods consumption continued to contract in the second quarter and is consistent with the further decline in the FNB BER Consumer Confidence Index. In July, retail trade sales declined further, in contrast to positive wholesale trade sales. Domestic new vehicle sales continued their negative trend in July and August, while exports of motor vehicles have remained robust. The outlook for consumption expenditure growth is expected to remain constrained, given the unfavorable employment outlook, the absence of significant positive wealth effects, and the slow pace of growth of real disposable income of households. Average wage growth and wage settlement rates have declined slightly, but there are risks of increases in excess of inflation and productivity gains. Credit extension to households continues to contract in real terms, likely driven by both the supply and demand side considerations. However, there has been a moderate increase in mortgage credit extension. As before, growth in credit extension to the corporate sector has been more resilient but below its recent peaks. Food prices remain a significant driver of inflation given the persistent drought, although long-range weather forecasts suggest improved rainfall prospects in the coming months. Food price inflation is still expected to reach a peak in the fourth quarter of this year at around 12.3%, slightly lower than in the previous forecast. Spot and future prices of wheat and maize have declined in recent weeks, but meat prices are expected to rise further as farmers restock their herds. Global food price inflation has increased mainly due to an acceleration in the price of sugar. International oil prices have fluctuated between $40 and $50 per barrel for the past 6 months amid uncertainty relating to a possible supply freeze by OPEC. The assumption for Brent crude oil in the bank's forecasting model is unchanged and assumes a moderate increase over the forecast period. After 2 consecutive months of price declines totaling R1.17 per litre, the domestic petrol price is expected to increase in October due to adverse movements in both the exchange rate and international product prices. The Monetary Policy Committee has noted improvements in the expected inflation trajectory during the course of the year. Apart from the tighter stance of monetary policy, this has also been driven by lower starting points as inflation surprised at times on the downside and changed assumptions underlying the forecast. The expected peak in headline inflation is notably lower, and an earlier return to within the target range is also expected. Most of the changes have been for the current and coming year, whereas the changes in the forecast for 2018 have been marginal. Changes to the core inflation forecast have been less pronounced, but it is no longer expected to breach the upper end of the target range. Despite these improvements, the longer-term inflation trajectory remains uncomfortably close to the upper end of the range, with high wage settlement rates and inflation expectations contributing to this persistence. The MPC assesses the risks to the inflation forecast to be more or less balanced at this stage. The current level of the rand is stronger than that implicit in the forecast, and in conjunction with continued low levels of pass-through from the rand to inflation, the risks are assessed to have moderated somewhat. However, some of the positive factors impacting on the rand may be temporary, and the rand remains vulnerable to both domestic and external shocks. The other major risk to the inflation outlook relates to food prices. The forecast still expects food prices to peak in the final quarter of this year. The future trajectory of these prices will be highly dependent on the normalization of rainfall in the coming months. Favorable weather patterns could see food price inflation falling faster than that implicit in the forecast. Despite the improved growth performance in the second quarter, the growth outlook remains constrained as reflected in the more or less unchanged outlook for the next 2 years. The MPC assesses the risks to the growth forecast to be broadly balanced, and growth prospects remain dependent on global conditions, implementation of structural reforms, as well as changes in business and consumer confidence. Given improvements in the inflation forecast and the weak domestic economic outlook, and the assessment of the balance of risks, the MPC has unanimously decided to keep the repurchase rate at 7% per annum. The MPC remains concerned about the overall inflation trajectory, which remains in the upper end of the inflation target range. The MPC is of the view that should current forecasts transpire, we may be close to the end of the tightening cycle. The committee is aware that a number of the favorable factors that have contributed to the improved outlook can change very quickly, resulting in a reassessment of this view. The bar for monetary accommodation, by contrast, remains high, as the MPC would need to see a more significant and sustained decline of the inflation trajectory to within the inflation target range. We have reached that time now when we have to take your questions. And as usual, please identify yourself and the media house that you come from, and we will deal with your questions. Hillary.
Governor, I think I want you to go over what you said in the last couple of sentences more explicitly. You are signaling, as I understand it, a possible end to the hiking cycle. Under what conditions would that be? And what could, that is a new stance, as I understand it. Can you just spell out in more detail what's prompted it and what could derail it? Thanks.
Yes, ma'am.
I'm Bata from Bloomberg News. Given what you've said has been the surprise in the inflation and where it's landed, and the fact that just the whole sentiment of your statement, could we see a more sustained pause to the tightening cycle, which you said the MPC had put a pause to the tightening cycle in July? Could we see a more sustained pause to that?
Stella?
Governor, you say that you're saying the bar for monetary accommodation remains high, but would it be fair to say that right now the chances of a cut are more likely than they were in July?
Yes, sir.
A viewer from CNBC Africa. I understand that
Again?
a viewer Mtila from CNBC Africa. A viewer.
A viewer.
Yes, sir. I understand that Brexit hasn't impacted the South African economy as drastically as was predicted, but I'm just wondering, what are the long-term concerns regarding Brexit and the investment outlook?
Hillary, I'm not sure if I was fast. I thought that I really slowed down in the last sentences. And you say, can I go through that slowly? No, let me deal with the question. You asked whether, well, this is a new stance. Every MPC meeting has got its own stance. We had consistently said that we are on a tightening cycle. And at the last meeting, we said that we have pressed the pause button on that tightening cycle. And in this MPC, we said that the inflation outlook is better than what we had seen in July. And given that improved outlook, it has enabled us to pause for longer. But we are also saying that if the inflation outlook, as we have projected it, persists, and we are saying that the balances of the risk to that outlook are balanced, if those are realized, then we are saying to you that inflation is expected to remain within the target range for longer. And if it remains within the target range for longer, we might be reaching the end of the tightening cycle. We are also highlighting, though, that there are still risks to the inflation outlook, and that the positive surprises that we had seen that had driven the inflation outlook, should they change suddenly, it would then force us to revisit the assessment that we had actually given. And we take that MPC after MPC. At every MPC, you have got to do that assessment. And you said, what are the factors then that you would be considering? They are exactly the same factors that we have been considering all along. What is happening with potential growth and what is the output gap? What is happening to the key drivers of inflation, whether they are oil or whether it is the exchange rate or whether it is food prices or whether it is unit labor costs. The answer might be different, but the question remains the same. Amkhanang, you say that any sustained pause, you don't sustain the pause. You sustain your inflation trajectory. We're saying that we expect that inflation will be sustained within our target range. And if it is sustained within our target range, it gives us that room where we might be reaching the end of the tightening cycle. That said, as we had spelled out, there are a lot of uncertainties at the moment in the economy and in the global financial markets, and that should those change for the worse, we will do a reassessment and we will make the call. And I think that's just to emphasize that in making that call, we need data. So don't forget that whatever decision we take will remain data dependent. Okay, I guess that still deals with Stella's question of how high is the bar. Aviwe, long-term impact of Brexit. The impact of Brexit had been more muted than we had initially thought. On the day that the results came out, the rand was the worst performing currency after the British pound. But we clawed quickly all of those losses and had actually now even appreciated to pre-Brexit levels. The UK is a very important trading partner for South Africa, being an important source of investment. It's also an important destination for our exports. It's also an important source of tourism for South Africa. It's a very important trading partner. Long term, what does this mean? It's difficult to say what this thing means. I am told that there are hundreds and hundreds of agreements that the UK must renegotiate. There are also pieces and pieces of legislation that they would have to review as a result of their exit. What does this mean for South Africa? Difficult to tell what it actually means for South Africa. Suffice to say that South Africa remains an attractive investment destination. Shall we take the next round of questions? Amukela.
Governor, given that the inflation trajectory has improved somewhat, was a rate cut discussed at this meeting? And my second question is, we know that...
All right, that was Lesetja Kganyago, our Reserve Bank Governor, announcing, as expected, that there will be no change in interest rates today. Something unexpected. We are in an interest rate hiking cycle. We haven't seen many rate hikes. They've been few and far between. But the expectation has always been that we could see a few more hikes going forward. Now he's saying that we could be coming to the end of the tightening cycle. That means no change in rates or even a future decrease in interest rates. Very good news for indebted South Africans. I think we've been given a breather that we didn't expect this year. Also good news for the economy. The upward revision in economic growth, the Reserve Bank's economic growth forecast from 0%, basically no growth whatsoever, to 0.4%. And at this point, we'll take what we can get. I will be speaking to Onan Komo and Tabi Lioka, get some more analysis on this after this break.
Do you need a funeral policy?
Joy is found in the little things.
Ke ho phedisa, ho fepa le ho hodisa.
Ukuba ibone ukuvela kwethuba lalokho okungenzeka.
In being there when one journey ends and another begins.
'n Idee van die klein dingetjies wat kosbare herinneringe word.
Life is the gift of growing new memories each day.
So that our loved ones can preserve them after we are no longer here.
Life is a gift to us.
Since 1918, AVBOB has comforted and supported South African families in their time of need.
Protecting their loved ones' memories with respect and dignity.
Plus, committed and trusted funeral representatives
With more than 250 branches nationwide.
There for you every hour of every day.
AVBOB provides a complete funeral service solution for everyone, even if you're not an AVBOB policyholder.
Make sure your family comes first. Always. AVBOB. We're here for you.
If you would like AVBOB to call you about a new policy, SMS family and your name to 41790.
Welcome back. You're with SABC News. We're bringing you a special broadcast following the Reserve Bank's Monetary Policy Committee announcement on interest rates. No change in interest rates as expected. That was announced a few minutes ago, but some interesting announcements in today's delivery by the Reserve Bank Governor. I'm now joined by Tabilioka from Argon Asset Management and Owen Nkomo from Nkunzi Wealth. Thank you both for joining me. So anybody who has a mortgage could be really happy right now. He said we could be coming to the end of the tightening cycle. Owen, let's start with you. Were you surprised by that?
Yeah, it was a pleasant surprise. And as you can see, everyone sort of jumped onto that point straight after the governor's presentation, rather. And I think it'll be a good thing if we've come to an end of the tightening cycle. But I think there's still a lot of moving parts, honestly speaking. And I think one thing that's really glaring in my view, one of the guys asked about the Brexit. Because, see, if you have a look at the Brexit, there's still a whole lot of permutations, in my view, that still have to happen before a decision is made. And we cannot, in my view, rule out the possibility of things going the opposite way at some point. Some guys in the media have started debating the possibility. And if that does happen, then it changes the fortunes of the currencies, possibly. But I think that's an outlier. You know, it's a tail-end event. But at the moment, I believe that with the currency continuing to firm up and inflation continuing to sort of come in lower than, you know, where the governor would be more comfortable with inflation, especially, you know, making sure that inflation is at about 6%. That is great. But twice in his speech, he mentioned that he's worried about that 5.9%. I think he wants it a little bit more, closer to probably 5.5 odd percent, which is where I think we'll get more comfort to start speculating probably about, you know, maybe a reduction.
Okay, so you're right, because he said, he suggested that rates could come down in future, maybe after some stagnation, but like you say, he did say things could change, a lot of moving parts. And I want to speak about Brexit, but first your response to what he said today.
Yeah, I think that before we get too excited, 7% interest rates are still quite high. And that's because of, you know, they can't move in either direction. So they're still between a rock and a hard place. In terms of, you know, the Reserve Bank has always said their mandate is inflation targeting. So yes, inflation has come back for the first time this year, back within the target band. But it's going to be the only time this year, because we're going to see inflation increase because of petrol prices and food prices that are still high. He did also mention that food prices are expected to peak in the fourth quarter. So that's also going to undermine the slight dip that we saw in the August CPI numbers. So that prevents them from moving down. And also looking into 12 months ahead, yes, he did revise down their CPI forecast. But at the same time, there are a lot of risks, which he mentioned. Inflation expectations are still, you know, quite high. He mentioned the rand being quite a risk. So they, you know, as Owen also said, there are a lot of moving parts. The reason also why the rand is performing well currently is because we're getting this inflow of funds into emerging markets. So that's what's really sustaining the currency currently. And that's when you see or when you hear political noise, it shoots up again. And that's because it's so volatile. So we can't really use the current spot and say, and you know, and extrapolate it and say this is actually what's going to happen in 12 months' time.
Right. So it's all about the U.S. Fed Reserve not raising its rates this week. Good for the rand. But Owen, do you agree with me? Maybe it's even better than we think, because if I heard him correctly, he said that the current inflation forecast did not include the rand right now, meaning it's even stronger than the Reserve Bank's forecast that gives us these inflation expectations.
Yes, most definitely, you're right. I mean, the currency sort of firmed up in the past week odd from where it was just after the recent drama around Minister Pravin Gordhan, etc. And I'm clear that that noise has kind of died down, got consumed by other news as well. So I do think that if we do see the rand maintain levels below 14 for a protracted period of time, you know, we could be in an environment where, you know, these guys start getting more comfort, as I mentioned earlier, to start becoming a little bit more accommodative. And, you know, one thing I picked up as well that I think is very important from this current team at the Reserve Bank is that they also look at the global picture. They don't sort of isolate South Africa. They look at what's going on outside, like you mentioned. He spoke about Federal Governor Janet Yellen's decision not to move interest rates yesterday. And I think as we go to the end of the year, people are going to continue to guess whether or not Janet Yellen is going to increase interest rates. I personally hold a view that says it will be imprudent of her to do that, especially because we continue to see interest rates in other developed markets go down. We just recently saw a big move done by Japan, and I think the Eurozone is still under pressure in terms of growth. So is the UK. So should we have an environment where even in December there's no interest rate increase out of the US, I do think that we'll potentially continue to see a stronger emerging market currency inflows. We should help emerging markets currencies as well.
Toby, maybe you can explain this to me, something interesting. He said that the current rand strength is not only linked to the US Fed Reserve, but a major merger and acquisition transaction. What's going on?
Yeah, so we're seeing inflows finally from the SAB InBev deal. So that's what has also helped support the rand currently.
And is that a short-term little kick, Owen?
It is.
Sorry. Look, it could be a short-term kicker, because once the transaction is sealed and all the cash is done, you know, the currency will probably normalize. But I do get the sense that the guys have probably done some of the hedging trades already. It's just a exchange of cash at the moment. But yes, it's important at the moment. We've seen other transactions as well, you know, that have happened recently. But an 87-odd billion rand listing on the exchange, which is an indication, like the governor said, that South Africa still remains an attractive investment destination. We just remain our own enemies, I do think, you know. That's why you see the currency go all the way back to 1460 and it flashes back down to sub 14, you know. It's just a reflection of how the world looks at South Africa and says, there is something worth investing in here. And I think we just need to be more consistent about our communication to the rest of the world.
Do you agree with that?
Yes and no. So the inflow could have been actually a lot more from SAB InBev transaction, but we also had a significant outflow because of the Barclays disinvesting in South Africa. So what that did, it actually counted some of the money that we could have actually enjoyed from the SAB InBev transaction. I also think, you know, I think maybe I'm a bit too cautious than Owen in terms of where
it's good to have someone who sees the glass half empty, somebody who sees it half full.
Only because I think that we tend to look at the current spot, and it's quite dangerous to look at like the 5.9% CPI or the 13.40 that we have today in terms of the currency, without looking at the reasons why and whether the reasons are sustainable. And my fear is that, are the reasons sustainable? And if not, where do we see South Africa? Where are we in 12 months' time? And unfortunately, all these are exogenous factors. So the Fed, I believe that the Fed will raise rates in December, just like it did last year, but it's still very low. But what that will do is weaken the currency somewhat, because you'll start seeing flows out of emerging markets into the US, and then normalization perhaps back into emerging markets. So there will be, this is not a permanent state. I wish it was. I just think that there are a lot of exogenous factors that are at play right now. And I wish that there were more domestic factors, because domestic factors like strong growth would then sustain growth forward. So would sustain inflows, and that would support the currency and also support growth going forward.
I think something in here really backs you up, and maybe I can get a quick comment from both of you before we go to break. We were so excited when manufacturing data and mining data looked better in the second quarter and we had better growth. But where's it heading? He said that that's coming down in July already, so expected to change. So that's a bit of a blow for something that was good news.
So that's a good point, because people look at that 3.3%, and I had a discussion with someone on Twitter today explaining that that is actually a recovery from work stoppages in the mining sector in the first quarter, and that's why you had this huge exports in the second quarter that also supported this 3.3% growth that we had. Question is, Are we going to have the same strong growth in the third quarter?
Owen, your quick thoughts on that?
Look, I mean, I'm still personally, like you said, I'm an emerging markets bull. I'm sorry to say, because I really think that if you look at interest rate differentials in the environment that prevail in developed economies, I do not think that we're going to see that sort of reversing anytime soon. So we will continue to see, in my view, our money's coming back into emerging markets. And I say, if you look at what we write in our press in South Africa when stuff happens, like this recent Minister Gordon drama that I mentioned earlier, you know, it's stuff that the internationals are used to. They've been investing in emerging markets for a long time, and they know that these things do happen. And I think that it's not a matter of saying, where am I going to make the most buck out of my cash? And the emerging markets still provide better interest rate differential levels, even in US dollar conversions. I do think that, yes, America may increase interest rates, but they did that last year in December. I hold a different view that they cannot increase it in December because they're going to be the odd one out in the whole global space, and they don't want as strong a dollar because it's going to hold back their growth.
And you're right, we were still attractive after they did raise last time. Okay, we have to take a short break. This is fascinating, and we'll continue with Owen Nkomo and Tabi Leoka after this.
The courage to be the first. The confidence to rule on any terrain. The will to change the game. And the attitude of always being ahead. This is what it means to be the most awarded SUV lineup ever. To celebrate 75 years of adventure, we've introduced the Jeep 75th Anniversary Editions. And for 75 days only, get up to 80,000 Rand off on the rest of the Jeep range. Visit your Jeep dealer now.
The Goodman Gallery is celebrating 50 years promoting art from all sectors of life.
Actively involved in social and political life of South Africa, and we really have been. It's been a fascinating place to be and to watch.
Your personal style is synonymous to your signature statement.
Style is unique. It is a representation of you, your personality, the things you like. It speaks on your behalf, and it just represents the kind of person that you are, your uniqueness.
It's hilarious, you know, apart from anything else. It's the satire, the sort of commentary on what we kind of take for granted as we you know, we exist in daily life.
Vote for Wonder Boy with your heart. Vote for Wonder Boy with your heart and rands at cinemas nationwide.
For your weekly dose of arts and entertainment news, tune into Trends every Saturday from 12 to 1.
Welcome back. Let's continue our discussion on interest rates. No change announced by the Reserve Bank today, but two pieces of very interesting news. The Reserve Bank Governor saying that we could be seeing the end of the tightening cycle. He did say things could change, but that means that perhaps in future no change or even rates coming down. We were discussing that earlier. Let's move on. I'm joined again by Owen Nkomo from Nkunzi Wealth and Tabi Leoka from Argon Asset Management. Okay, so the other piece of good news is that I haven't heard this for ages, an upward revision in economic growth. Finally, everyone was so worried he would go from 0% down again, because we've just seen that forecast coming down. It's gone up to 0.4%.
Yeah.
Owen, how significant is that?
Now, look, I mean, it's good for sentiment. You know, just yesterday or a day before, we had one of the ratings agents. I think you were speaking to the lady, actually. You know, when she was reflecting on the possibility of a downgrade at the end of the year. I mean, a positive revision by our own bank. Let's hopefully get some more revisions by other guys as well. It's good for sentiment, and I think that if we continue to show that the new board, for example, at SAA, among other things, is going to come right, despite some of the changes we've seen that people have looked at negatively in terms of the state-owned enterprises. I think if we continue to build pieces of good news, and if we continue to show our commitment to changing some of the ways we've been managing our fiscus, we will likely avoid being downgraded, which is positive, and it's going to filter through to the currency, filter through to inflation. And yeah, I mean, just hope we can get some rain as well. The governor did talk about the rain.
Virtuous cycle, maybe the rain will come. Do you agree? Because Moody's, their own growth forecast is 0.2%, and they were suggesting anything below that could mean a downgrade. So this seems to be really positive that the Reserve Bank is being more optimistic.
I think Moody's said 0.3. Said anything below 0.3, then they would then will risk being downgraded. And so that's why this 0.4 is a significant upward revision to GDP, because according to their forecasts, they think that we will not be downgraded. If we look at the way Moody's has viewed us, we may not be downgraded because we will get around 0.4% GDP this year. My forecast is about 0.3, so more or less in line. But what this also means is that they underestimated the second quarter, and also they think that the second half will be slightly better than anticipated. Where I'm worried is that we do have a strike. COSATU has announced a national strike on the 7th of October and in KZN on the 8th of October. So obviously that will impact on productivity, and also we've got now an extra day of holiday that was announced by the president a few days ago. So working days are a little bit shorter in the second half of the year because of these shorter than previously.
It's the 27th of December. Does anyone work anyway?
It does. But you know, it does matter in terms of even just like output and productivity, especially on the retail side. Of retailers close at a time where everybody's supposed to be shopping. So there are little adjustments, but on the whole, I think it's a positive upward revision. We do know that the IMF has also South Africa at 0%, and it will be interesting to see how the IMF and World Bank now view South Africa's GDP.
So we're still trying to push this economy up the hill. Oh, and you mentioned something that weighs in, because we're in this global milieu of subdued global growth. And he was talking about Brexit. And look, I know that journalists always love to create a hype, but you have to agree that economists were worried. Everybody was talking about Brexit in very negative terms. And it doesn't seem so bad. Can we breathe a sigh of relief now?
No, look, like I said, there's still a whole lot of things that need to happen around the Brexit. You had him mention contracts that may have to be reviewed, agreements that may have to be reviewed in terms of trade, etc., etc. I don't think we're nowhere near getting certainty around that. So, in my view, the status quo is going to remain what it is at the moment for the foreseeable future around Brexit. If you look at the market that was supposed to have been hit the most, the UK itself, it didn't collapse around the Brexit. And now we did collapse in terms of our currency and our markets a little bit, but we recovered quite significantly, and he did mention that as well. So I think for now, it's a game of wait and see, really, about the Brexit in terms of saying what's Ms. May going to do in terms of her engagements with the rest of her colleagues in continental Europe. And I think at the moment, Angela Merkel has got her own challenges in Germany to deal with. So we have to watch and see, really, what happens out of Brexit.
Your views on Brexit or this global environment that we're in?
I think that Theresa May has been kicking the can down the road in terms of delaying any signing of as a Treaty 50, and I think that it is a wait and see. I think markets do not like uncertainty, and that's why you had this reaction in June, because the market hadn't anticipated the Brits to vote against Europe. And now that they have, I think because it hasn't been, this has never happened before, no one knows how to move forward in terms of applying all these treaties and signing agreements. And it'll be interesting. I think for us, our Minister Davis did mention that it could be a small positive, because now we could sign treaties with or agreements with the UK individually, and the UK is less stringent than the EU. And he used an example of this, black spots on oranges that we were banned to export to the EU, whereas exporting to the UK wouldn't be a problem because they are not that stringent on some of the products that we export. So us signing different agreements with the UK versus the EU could be a small positive for us.
Okay, we have to end. Let me ask you both to maybe just give me an idea of where you think this is going. Given what he said today, we could be coming to the end of the tightening cycle in terms of what's going to happen at the next rate meeting and what's going to happen to our economy. We know it's going to be tough this year. When do things get better? Starting off with you, Owen.
When do things get better? When we get a little bit of rain, I believe. If we do get some rain, we probably could see some more expectations of inflation coming down, etc. But I do think that also South Africa really depends on what happens with the rest of the global economy. If things improve in Europe, which at this stage the chances of that, in my view, still remain very debatable. And in the US, the interest rate decision is going to be very important in terms of what happens to South Africa. The currency and the oil price for us remain very key.
Your final word.
I think that he'll keep rates on hold at 7% for the remainder of this year and also the entire 2017. So we will not be seeing any hikes or tightening because the economy is still very, the growth is still very slow and also inflation remains a risk. I think that the economy will start picking up in 2018, but I think that we still need to reform the country in order for us to get sustained growth.
All right, thank you both so much. I've really enjoyed this discussion. Tabilioka from Argon Asset Management, Owen Nkomo from Nkunzi Wealth, and that's where we end this special broadcast. Thank you for being with us.
Now, this is Trends, of course, your one-stop serving of all that's juicy and trending in the world of entertainment and showbiz. My name, of course, is Refiel Wemwilo.
I'm Dr. Selom Daung, and this is our talk.
A very good morning and welcome to Media Monitor. I'm your host, Alicia Jolly.
My name is Dumile Matez.
William Mulebati.
My name is Mpo. What time is it? It's question time.
For your daily dose of current affairs, tune in to the SABC News Channel.
The Divas of Kofifi were honored with a musical production, taking you through the highlights of the lives of these remarkable women.
I just play this little role where I show the life and times of Mam Dorothy Masuku from when she moved from Bulawayo to South Africa.
I'm playing Tandi Mbambane Klassen. She speaks her mind. She doesn't take no for an answer.
I will be playing Mom Abigail Kubeka, who is one of the most prolific female icons in South Africa. She was a triple threat, which means she was a singer, dancer, actress.
For your weekly dose of arts and entertainment news, tune into Trends every Saturday from 12 to 1.
Campaign that is as a result of a Bill and Melinda Gates Foundation grant to Good Business in Saatchi, South Africa. We've developed this campaign specifically to encourage the prevention of the bacterium. And this is aimed at people around anybody who coughs, for them to tell the person who coughs, hey Bowena, use your elbow. Motivation was really coming from the Bill and Melinda Gates Foundation, who are involved in a number of projects in South Africa. And one of the biggest challenges has previously been said